My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Jason Buck, who some of you may have heard and seen with his own podcast. But Jason, introduce yourself to the audience. Who are you? What's your background? How'd you get interested, involved in market? And what are you doing with mutiny funds?
Perfect. I do a disclaimer as well, or is that just...
You are more than welcome.
I'll do it as well.
Exactly.
Nothing I say,
Good.
nothing I or Michael says for investment advice. Hopefully it's for an entertainment purposes only. Please seek out your own entertainment professional. Along those lines as well, I'm not sure I say anything original. I mean, everything I say is probably an amalgamation of other smart people. I'm not sure any of us really have our own original thoughts. So please seek out investment professionals. So who am I? What do I do? I'm Jason Buck. I'm the CIO and co-founder at Mutiny Fund. Mutiny Funds, we try to create total portfolio solutions where we try to bring institutional quality investment down to the accredited retail level. We got known for our specialty in volatility, specifically long volatility, as well as working with commodities and CTA trend followers. So what we try to do is provide offense plus defense, and we feel that's what wins investing championships. And most people are offense heavy. Outside of my day job, like Michael was saying, I do the Mutiny Investing podcast. I do a show on Twitter and all your audio podcasts. On YouTube with my buddy Corey Hofstein that we call Pirates of Finance. You can usually find us there every Friday at 3:00 Eastern. Then, speak on stages, other podcast shows like this. And so I appreciate you having me on. I'm excited to have a conversation. I see a lot of familiar faces in the audience. So this is great.
Okay. So, and by the way, it's funny. I'm glad you mentioned the disclaimer at the start because, when I tweet out NVIDIA is fucked, that's not a recommendation to buy or sell or short NVIDIA, right? Which is just kind of funny the way the social media frame things. But anyway, we'll maybe touch on that. So I want to go into this offense defense. So I think your framework probably is not that dissimilar to mine, trying to get to the same endpoint in different ways. When you talk about the idea, the cliche that defense wins championships, I think really what that hits on is up capture versus down capture, right? Against some benchmark. How do you think about what are defensive plays? Because it's more than just saying, I'm going to play defense. It's about the opportunity set with which you're playing defense.
Yeah, I think at a high level, the way to look at it, I think a lot of people look at their portfolios and they see this wonderful pie chart of diversification. And we would argue that that's typically like 99% in offensive assets. And what I mean by offensive assets, things that are, long GDP, long liquidity, for example, stocks, bonds, PE, VC, real estate, all of these things are, they're hoping for, the world is awash with global liquidity. Everything's up and to the right until bad shit happens. And then, as they say, correlations go to one and they all tend to go down together, no matter what their correlations were over the past decade. So on the defensive side, we think about, you compare those with the offensive side, and there you have everything from long volatility to tail risk with those deterministic puts. Some would argue you get defense out of commodity trend advisors that are more uncorrelated to markets that can switch kind of back and forth. And sometimes if people even want to argue that, cash and or, 90-day T-bills is a defensive asset. I'd agree with that as well. And then, what's real debatable around the fringes then is if gold and Bitcoin are defensive assets, but I'll let others probably duke that one out.
Yeah, no, okay. So this is good. So, and I like the framework of volatility because I always say that, risk on, risk off isn't about direction. It's about volatility dynamics changing. So when you're in a risk on environment, volatility tends to be lower than when you're in a risk off environment, volatility tends to be higher. Talk about how do you play long volatility, because the way that most individuals tend to think of that is they look at some of these VIX futures, ETPs. They've got the bleed, and your timing has to be so spot on to try to play volatility that you often get ground to zero by the time you're actually right. But talk about how you do it on your end.
Yeah, this world is a crazy world of long volatility. Actually, to say it's the last bastion of active management, because as you referenced, if you try to passively hold some of these ETPs or time and volatility space, it's pretty down and to the right if you look at most of those charts. The other thing you said, I think what I like about risk on, risk off is, back in the day, I was a commercial real estate developer. And this similarly, if I'm projecting my pro forma 10 to 5 years out on a building I'm working on or constructing or about to lease up or flip, I need volatility to remain, constant or to go down if I'm going to hit my projections 2 to 5 years out. So that's the other thing when you have risk, risk on comes back and volatility picks up, all of a sudden your P&Ls and your pro formas tend to go out the window. So thinking about volatility, we look at it through many different lenses. And the way we try to think of it most is through this triangle, tripartite way of looking at it is you have carry, convexity, and certainty. Now you could choose one or two of those, but you're never going to get all three. So what do I mean by that? So if you think about classical tail risk hedges, that's the idea of say buying a deep out of the money put on the S&P 500. And let's say you use a attachment point of negative 20% down. But you buy in those teeny options, that's going to give you an unbelievable amount of convexity, a solid amount of certainty. We'll get into the monetization later about maybe it's uncertain, but your carry is going to be negative, right? So you're getting convexity and certainty, but you're missing out on a bit of carry. So then we come to the world of long volatility. Some may argue that's just purely, playing implied volatility. Others just may say that's a new form of tail risk hedging, which is more opportunistic. But the idea there is you might be buying, either tail, either left or right tail, and you might be doing it opportunistically. So your, typical managers there are running their own algos and their own trading systems where they're trying to find, potentially where a forest fire could spark off, right? So they're looking at wind speed. They're looking at what's the ground moisture, what's been fires in the most recent history, is there power lines in the area? They're looking at all those things so then they can opportunistically buy that long volatility, that long vega, that long implied volatility. And the idea there is they can hopefully reduce the bleed of just buying those tail risk options on a more systematized basis. So in this scenario, you might be lowering that carry, trying to get it close to zero or even positive. But now you might be, giving up a tiny bit of convexity, but more importantly, you're giving up certainty because you better be able to time that market, right? And what is, some sort of exhaustion event happens over a weekend and the markets aren't even open and you didn't have a protection on beforehand. So that's another way to look at, playing long volatility. The third way we look at it is what we call, short delta positions. So if you're, classical tail risk hedging, March 2020 happens, implied volatility expands, your tail risk starts to pay off. You go to monetize those, and we'll get into monetization heuristic later, hopefully. Now you have to roll those positions, right? If you want to protect against the second or third leg down, and that's going to be prohibitively expensive due to the rise in implied volatility or vega. So what we try to do is use some intraday trend following managers that can short those market indices around the world. We like some managers that play, Europe, Asia, US markets idiosyncratically. So either they're going to follow that relay race around the world, or they may be able to take advantage of when there's some, short delta plays on those stock indices around the world, then they can just go directionally short and they'll have to play up for that implied volatility. So we kind of think about all those different markets, whether we're talking futures, options, or VIX markets. And I'll go back to VIX. Basically, the world of VIX, in my mind, in a professional way, is the relative value world on VIX trading. And the idea there is you're usually intra-market spread between the VIX and the S&P, or maybe calendar spreads, and maybe you're using the futures or the options to express those. But the idea is it's like any pairs trade. It has a implicit mean reversion bias, but you're trying to get your ratios right. So maybe you're trying to even isolate that roll down yield that you can get out of VIX. And that's how you're affecting your carry there. But, relative value is a very different play from long volatility or tail risk. But it tends to pair nicely, especially if you combine managers that try to run those ratios market neutral, or they tilt towards long volatility, or potentially they buy wings, or they can quickly move from, a market neutral to a long volatility bias in those scenarios.
I remember, maybe 15 years ago, 20 years ago, I forget who it was, but there was some hedge fund manager that basically argued there's only two types of assets, those that benefit from low vol and those that benefit from high vol. Talk about other ways of playing volatility. So you touched on gold, maybe is debatable. Gold does tend for a moment in time act a little bit like a relative safe haven, but, can go down obviously when markets go down. Same deal with long duration treasuries. Historically tends to be, a way of playing the VIX without the risks of shorting or playing the VIX directly. But obviously last year was horrendous. But are there certain ways of playing volatility that are, in quotes, safer over time that allow you to be wrong in your timing, but still have some degree of convexity?
Sure. It's a way to think about those trade-offs, right? Between carry, certainty, and convexity. So a couple ways we look at it. I like how you saying risk on, risk off, or short vol, long vol. Another way of saying is offense, defense. And so we start through that rubric of the world is either, you're in offensive or defensive assets, and we like to pair those. And then when we go down below that, we try to look at the world through the 4-quadrant model that Harry Brown developed. And the idea is everything's on the axis of growth or inflation. And so then we try to tranche out our portfolios that way. So for example, in a Harry Brown scenario, you had, stocks for growth. You had bonds for disinflation or deflationary environments. You had cash for recessions. And then you had gold for inflation. The idea, I think, if Harry Brown was alive today, he used maybe our modern tools that we have where we build ensembles, the long vol tail risk to supplant the gold. That way you have that convexity you were just mentioning. And then instead of gold for the inflationary piece, we use CTAs, commodity trend followers that are primarily still trading commodities in a trend following fashion. We just believe that has a higher beta to inflation. We also tend to hold a little bit of that gold in cryptocurrency we call them fiat hedges in case like something truly cataclysmic happens. Because we're trying to manage, multi-generational wealth for our clients. We're also trying to truncate any form of left tail because we believe, like you had our mutual buddy, Meb Faber on the pod last week, or on the show last week. And, Meb was talking about, as usual, it's like surviving is the only success. So that's what we're really focused on when we construct portfolios, is combine that offense, defense, that 4-quadrant model, because surviving is the only success. And because you brought up, bonds, for example, historically, if we look back the last 40 years, this is how, 60-40 became so popular, is because you had that negative correlation with bonds. Well, if we look back over 100 or 120 years, stocks and bonds are actually correlated more often than they're uncorrelated or negatively correlated. That usually typically also happens in inflationary environments when they become negatively correlated. And so that's how you saw people really get offside in 2022. So it's like, once again, that bond can provide that balance. What you're referencing to over the last 40 years, which has been nice with bonds or long-term treasuries, is you've had that nice positive carry. And then when markets sold off, Fed was lower rate, and you have this explosion in the price on like PLT or long-term bonds. So you almost have the positive carry hedge. You didn't have a ton of convexity or asymmetry there like you can get with put options, but you did have a nice hedge. Now, that is obviously flipped in 2022. We'll see what it looks like moving forward. And then the last one, you brought up gold, for example. I mean, like I said, this is why other people could fight this out. It's like, I've been studying gold for decades, still don't know what it is. I think gold helps maintain your purchase power parity over longer term time horizons. That's why people test it over thousands of years. But in any quarter or a year, it might not provide the ballast you're looking for. Like in March 2020, everybody was selling off their gold, not because they wanted to, but because everybody's looking for cash, and we're in a liquidity cascade, as our buddy Corey Hosting likes to say. So, is gold that provider you're looking for, or is it more, maintaining, the same as you would have a medieval armored suit, is allegedly the same price of or purchase power parity with gold as you have a bespoke suit on Savile Row today. But like, does that really help you in any intervening quarter or year to really protect your portfolio? I think that's up for debate. And then Bitcoin is just a tiny piece of our portfolio. But once again, we call that a fiat hedge, because what if the Bitcoin maxis are right? What's the asymmetric convexity in that kind of scenario if we're trying to maintain the purchase power parity of our clients?
Yeah, and I will say just real quick on Bitcoin, I agree with that point. I often rant against the narratives in the Bitcoin space and crypto space, but I always go back to the truest definition of the market is all assets, right? It's not the S&P 500, and of which you would categorize Bitcoin there. But you said it correctly around the 1% kind of or weighting type of dynamic. So how do you think about weighting all these different parts of a portfolio? Because this is, I think, where a lot of people, they tend to not think too deeply about how much to own of something. They always have theories for what to own, but never the sizing parts, right? As far as how that marries into their view.
Yeah, I tend to break kind of everybody's metrics for how much they own, especially when Meb does any sort of survey on his Twitter. But you're leading me perfectly into it. Like I said, we think about the world first from offense and defense. Then we kind of look at it through the 4-quadrant model that Harry Brown developed. But then what you're talking about is correlations, right, over time and sizing. And so where I think was interesting about Harry Brown's 4-quadrant model, it was just a quarter each in stocks, bonds, cash, and gold. And honestly, Dalio copied that and just levered up the bond side and came up with risk parity in all weather. So that's a portfolio construction technique to pair everything based on variance. Everybody likes to say it's volatility or risk, but I don't believe volatility and risk are synonymous with variance. I actually think it's more you should be worried about drawdown. And that's the reason why we wouldn't necessarily lever up the bond side, giving any sort of look back in correlation. So when we think about pairing these, we use equal parts global stocks, equal parts global bonds, equal parts our long volatility ensemble, and equal parts our commodity trend advisor ensemble of trend following commodities. And then we sprinkle in a little bit of gold and a tiny bit of crypto. So thinking about those portfolio construction waves is we think we have equal parts offensive, defensive assets. So we're happy about that. And you have to think about, the stock side we believe is ballasted by the long volatility and tail risk. And then the bond side is ballasted by the commodity trend advisors. If you think about those axes of growth and inflation. But what's nice is if you have these very linear instruments that do really well in a long GDP environment like stocks and bonds, but then you have fairly convex instruments with long volatility, tail risk, and commodity trend advisors, it's really pairing the linear with kind of the convex. And it's a nice way to balance the portfolio or to rebalance it over time. Then when we think about weighting the gold and crypto, we have, I don't even know if I can give exact numbers on a live Twitter spaces, but we use, small amount of gold and a tiny amount of crypto. And the idea is if you got into a cataclysmic scenario where markets shut down, et cetera, diasporas, wars that we've seen kind of over the centuries, how much would you actually need to hold in like physical gold or physical crypto in case either the gold bugs were right or the Bitcoin maxis were right, you'd have pretty exponential returns on there. So you don't really need to hold that much. If that's your stated goal, is more to protect the purchase power parity if kind of global liquid markets shut down.
Get some of the audience up here in a second, but I am just curious to hear your take on where we are just cycle wise. I'm personally of the belief that we're probably in a, age of turbulence, to use a Greenspan term, right? And I say that only because that doesn't mean that you necessarily have to have a prolonged bear market, but just a more volatile bull market, even within that construct. But I do think that what's also missed is it's more than just sort of the idea of, to your point, stocks and bonds have been correlated plenty of times. It's about the interaction when you need it the most, right? That's kind of the old joke about diversification, is that often fails when you need it the most. Risk parity, you can argue, failed last year because that levered treasury side was actually the biggest source of pain, whereas that tends to be, where you get the convex counter, at least to some extent, against equities.
Yeah, I think the easiest way to think about this, another way I think Dalio's wrong, is so when we think about offense, defense, then we think about our 4-quadrant model, and then we think about correlations. If Dalio will tell you look for 16 uncorrelated asset classes or return drivers, I just don't believe that exists. So I think most things are correlated with the S&P 500. Like we talked about those long GDP offensive assets. When push comes to shove, they're all going to be, very highly correlated. So what you can do is then build structural negative correlation in your portfolio with, put options and long volatility. Then I would argue that the CTA trend followers are uncorrelated, so they're going to kind of go, you don't know which direction they're going to go compared to those other two parts of your portfolio. But those are the only 3 correlations. It's correlated, uncorrelated, negatively correlated. As far as where we are in the cycle, I have no idea. And that's the way I built portfolios, is like, what if I can admit I don't have a crystal ball and I can't predict the future? I mean, you and I've been around market for a long time, and, wonky shit happens every day that I didn't think was possible. And so I watch my friends battle it out on the global macro stages, and, one's long TLT, one's short TLT. Which one's right? I have no idea. I mean, we'll find out in the future. And then one's going to call, some people call the one that's right a genius, the other one an idiot. And then, next time they'll call something else different, and it'll be vice versa. So just seeing that enough times, the way I construct portfolios is I just try to combine offensive and defensive assets. I combine the offense that everybody wants in a very capital efficient way. And then I combine that defense because bad shit happens. Do I know when it's going to happen? Absolutely not. So the only timing mechanism I use is we rebalance the portfolio. Now, Harry Brown originally came up with a rebalancing band, which I wish you could kind of do rebalancing bands because let things kind of move around a little bit. But given the functions of running a privately traded fund that has inflows and outflows, we rebalance the entire portfolio on a monthly basis. But we don't do an overlay where I pull out my crystal ball and I discretionarily go, we should really get rid of these bonds or attenuate the portfolio to, we think, growth is coming or inflation is going to be persistent. We don't do any of that. It's still always equal weight, the asset class of return drivers. And then we rebalance those monthly. And I think that allows us to kind of scale trade those asset classes as, global liquidity moves between those asset classes as money moves around the world. We just want to move with it as well.
So I shared at the top of the Twitter space your tweet about, or a quote, right? I can tell you some of the richest people in the world are struggling to talk to a girl. There's no way these people are leading some fucking global conspiracy. And I want to actually relate that to investing and markets, because there is this narrative out there that there's a degree of vol suppression, that the Federal Reserve that everybody always rants against as being incompetent is somehow doing something to keep the VIX, with its putting a thumb down on the VIX, which I would argue is a little bit of a similar take on the tweet, right? If they're incompetent, then how are they able to do that? Is there anything to the idea that volatility is suppressed, that there's some kind of third-party actor that people really aren't seeing, but is somewhere out there just kind of keeping things in a lower range than they should be?
And there's so many pieces to that question.
I was trying hard to find a link to the tweets. That's the best I could do.
No, there's no, I like it. There's so many pieces to it. Conspiracies, everything. But I'll start with, we're talking about integrated complexity, interacting with integrated complexity. And I'm not sure anybody knows the ramifications of anything. And I think it's hilarious when I watch the global macro pundits, lambaste the Fed or all that stuff. My question always, first of all, is like, well, okay, you're the head of the Fed. What would you do? And they're like, oh, well, I'd quit. I wouldn't want that job. I'm like, well, it's not the easiest job in the world. And it's easy for you to sit in the cheap seat and second guess everything they do. More importantly, if you are a trader or investor and you're in financial markets and you think that the Fed is either a global cabal, a conspiracy, or incompetent, well, guess what? You could trade against them or with them. It's your choice. So I think it's hilarious to me that usually the people that have the most ire for the Fed, usually if you look at their P&L, they're down on the year. So like, I think it's really interesting that people that really like to go at the Fed, like you should just be about making money, not about what's right in the world, especially if you're running money for clients. So that's part of it. As far as global volatility suppression, generally so volatility just goes through cycles, almost like everything, right? Volatility can cluster or mean reverts. I mean, I think a lot of people on this call might know that Benoit Mandelbrot, but the idea too is after, as Hyman Minsky said, if you suppress vol, that suppression of vol leads to a Minsky moment and vol explodes, right? And then after vol explodes, everybody wants insurance after the flood. So it clusters for a little bit, but then it starts compressing again over time. And so volatility waxes and wanes. But in general, I think markets in general love a low volatility environment, right? Capitalism loves a low volatility environment. People love to sell insurance. And so I think you're going to have large movement of different idiosyncratic players that in aggregate looks like they may be putting pressure on volatility and suppressing volatility. But in general, I think human beings kind of love the suppression of volatility. And like I said, as a business owner that has to project, years out, I prefer volatility to be stagnant. But I think that's what you're seeing. It's more market players than not love to sell vol than necessarily buy vol. So that's where you're going to see people complaining about some sort of suppression of volatility.
Yeah, I think that, correct me if I'm wrong with this, but I think the whole Minsky moment idea is the transmission mechanism as to why that happened is because when you're in low vol regimes, it encourages players to take on more leverage, right? And recency bias, basically saying that, recent low vol means future low vol. So let's lever that up and try to increase returns. The moment happens when you have a margin call, when a butterfly flapping its wings creates the sort of deleveraging effect.
Yeah, no, you said it perfectly. I mean, Minsky is primarily talking about credit, but as he said, stability breeds instability. And so as vol gets suppressed and you're looking at a rearview mirror, right, you're going to start taking more and more leverage to target the same return. And so over time, people get way out over their skis when getting more and more leverage. And it gets to a point where people can't even not only make their principal payments, but then they can't make their interest payments. And then that's what Minsky called Ponzi finance, where just any sort of air pocket is going to make us crash down. Now, the problem is, you and I have been around a long time. It's like betting on when that air pocket's going to happen. I think it's exceedingly difficult.
Okay, so there's the conspiracy aspect, like I just mentioned with the Fed. There's also the sort of newer dynamic of increased trading volume with options, Euro DT, and all this. Do you get a sense that volatility dynamics have changed compared to history because of all of these active players on the option side, or is it just not doing all that much that we can tell so far?
Both, really. Yes and no is the answer to that. I think vol markets really change every 2 to 3 years. So I always say, if somebody's trying to show you a back test for a long volatility strategy, that goes back prior to 2010, I would kind of throw it out the window because you have the rise of the ETPs in that 2010 to 2012 window. Things start to change and expand depending on who the players are in the market, right? We lost a lot of those short variance, sellers going into March 2020. And so they're not coming back. Maybe they'll come back next year. So as vol surfaces change, what's really cool is you can look at maybe I'm just too weird to call it cool, but you can look at vol surfaces and they're constantly undulating and moving. And if you look at them through time, they're quite beautiful things the way they move around. So vol markets are a thing that constantly changes. So you can't necessarily use historical volatility or historical patterns to predict where volatility is now or where it's moving into the future, just because you have different players. And, the newest one on the scene obviously is zero DTE options. Now that doesn't necessarily affect VIX calculations as much, but there's different markets, different players. We saw the meme stocks, none of this stuff is historically represented. And that's what I think is interesting is we're constantly in this, rear view mirror, this Kierkegaardian problem is we're trying to understand the present and the future through the rear view mirror. And we never can. We're always fighting the last battle. And you saw a lot of that happen in 2022, even with deep out of the money vol players. They did exactly what they were supposed to do, but you had a, slow drip and grinding market, and that deep out of the money kind of long Vega player is not going to do well in that environment. And so if people were, really attenuating their portfolios to a March 2020, where you have a liquidity cascade from a low vol environment where vol really spikes, that Vega jumps. So those are two very different scenarios. So as those vol surfaces constantly change and update and different players coming in on the system, especially when you have the real money institutions like Canadian pensions and everything, determining, where they're at, if they're selling vol, if they're long vol, if they're, hedging their portfolios, if they're reducing their equities exposure, all of those things tend to affect the vol surfaces quite significantly. And you see different points in the surface where, things can get a little bit out of whack.
Just to reset the room for the remaining minutes or so, but please make sure you follow Jason Buck here on Twitter. If any of you want to come up and ask questions, click that bottom left microphone button. And as always, this will be a podcast under Lead Lag Live on all your favorite podcast platforms. Okay, so in terms of volatility, we touched on a lot of different areas. I know you wanted to talk about capital efficiency, but before we do that, I want to talk about naming efficiency because you named the portfolio, the cockroach portfolio, which I think is funny to me. The cockroach portfolio is basically what? It's essentially your moniker for owning all the things that will work, I assume, no matter if we're in a nuclear war. Is that the idea?
Yeah, you said it perfectly. And you're somebody that's very good at branding and marketing. So I appreciate this conversation. But yeah, the idea was both my partner, Taylor Pearson, and I come from outside this industry, right? We were trying to solve a problem for our families and friends where they could get access to these long volatility and tail risk products and managers if they had less than 150 million bucks. And so, coming from outside, you're going through all these naming conventions, and I'm sure you've gone through this a million times. You're trying to come up with a name. You think you come up with a good name, and then you go Google it and it's already taken. And so, our original working title for our firm was Ataraxia, which comes from the ancient Greek, unperturbed by external events. Luckily, my girlfriend and Taylor's wife are like, you guys are not going to use that. So eventually came up with Mutiny Funds, and we have this very pirate-like theme as we're outsiders. As Job said, we're pirates. Nobody wants to join the Navy. And so we acknowledge who we are and that we come from the outside. So that's how our original fund started as Mutiny Funds. We originally started with our long volatility ensemble fund first, knowing that was the cornerstone piece of the overarching portfolio. And that total portfolio solution is Cockroach. And like I said, the idea in Cockroach is that we're trying to hold all the world's liquid asset classes and rebalance. And just like you said, I got told by everybody not to call it the Cockroach portfolio. Everybody says it's a terrible name. People are going to get upset. People are going to like it. And all I kept asking was, will you remember it? And what do cockroaches do, right? They survive anything. And so that's all I care about because I just got pissed off of like a lot of the managers I work with and everything are all using like 3-letter acronyms. And once we get past, 5, 10, 20, 50 3-letter acronyms, I can't remember any of them. So, thinking of branding and marketing, we want to make something that's memorable. And if you can come up with a word that is the embodiment of what your portfolio is trying to do and what you're trying to do as a company and as individuals, like that's a perfect scenario for me.
It's not like if a client comes into your office that you're showing them an actual cockroach. We just, you don't have like any
dump a
prop
box
like
of cockroaches. Well, that's actually made me think like I love Jason's Wags. It's one thing to show somebody a picture of a snake. It's another thing to throw a snake in their lap, like referencing like when people are always like, oh, when the market's down 30%, I'll buy. And you're like, yeah, it's easy when we're talking about it theoretically. So yeah, I wonder if we should just unleash a box of cockroaches just as a very even more visceral reminder.
I would love to do that to most of my haters if I could, but there's no way for me to do that. Okay, so let's talk about, you want to touch on capital efficiency. I'm not sure in the context of what, but I'm going to assume that maybe you're of the mindset that markets are not as efficient at the allocation of capital like they used to be. If that's not the direction, we can go in any direction you want, but what is it about capital efficiency do you think that's worth talking about?
Yeah, I'm actually going to take it a slightly different direction. So we think about those defensive assets, we've been talking about this long volatility and tail risk, but we like to pair those equally with commodity trend advisors. And we try to still find managers that are trading predominantly commodities, which is surprisingly hard these days. Understandably, the 2010s were really difficult for the CTA industry. And so a lot of them, are trying to raise and gather AUM. So they kind of shifted away from commodities and went more into the financials. So we still try to find managers that are predominantly trading commodities because we're trying to get that beta to an inflation-like environment. But the idea is to pair those two together because they tend to work, kind of synergistically in any sort of, risk off scenario. So if we look at March 2020, you had this liquidity event. That's when your long vol and tail risk are going to do incredibly well, coming from low vol to high vol, as we said, those Minsky moments. But if you have a much more slow drip, protracted recession, like we saw maybe towards the end of 2008 or we saw in 2022, it's going to be very difficult for those long vega, those long volatility, those long implied volatility players, because if the VIX there's a simple heuristic. If the VIX is at 16, it's the rule of 16. That means you're expecting 1% plus or minus daily moves. If the VIX is at 32, then it's 2%. So it's the rule of 16 there. And so the idea is, even if the VIX is at a 16 handle throughout the year, if you're seeing the market just drip down 1/4 to 0.5%, even on a daily basis, you're never going to tick off that implied volatility because it's that 1 month forward variance. So you can have markets that drip down like we saw in 2022. And you're not going to see a lot of performance out of your tail risk managers unless you get down to that lower delta point where they have the attachment point. So that's why we think that, CTAs tend to pair really well with long volatility, especially on the defensive side. If you have these, more protracted recessions, or if you have, inflationary environments, where commodities start spiking off, you want those commodity trend advisors going to follow those trends. And it remains to be seen, how well volatility or tail risk players can do in a higher inflation environment, whether it's per se inflation or rising inflation. So it's about pairing those two together. So we think about putting those two together, you need to then pair those defensive assets with your offensive assets. And so as some people say, it's like, how do you fund that? Well, I wish more people knew about futures and options space because of the capital efficiency you can get there. Most people understand stocks and bonds, and they understand, their personal portfolio. If they go to borrow from Schwab to get leverage, how much they're going to pay for that. Well, when you're operating in futures and options space with these performance bonds, you can get much greater capital efficiency, and you get the lowest rate possible for any of that efficiency. I mean, some of it's going to be baked in the term structure, but you try to offset that by holding T-bills. So you really don't have to put up a small percentage as a performance bond to hold these positions in futures and options. So what that allows you to do is, like I said, even though we're using a quarter each, those global stocks, global bonds, long volatility, and CTAs, it allows us to use the implicit leverage that we can get in those spaces for greater capital efficiency, because you need to give people still that same exposure to those long GDP, those offensive assets like stocks and bonds. And then you want to pair that with those defensive assets. But, hopefully they're kind of muddling along in those risk on times, and then they jump out of the curtain when they need them most and risk off. So that's why I think, there's a debt cash problem. I think that happens in a lot of long volatility, or when people try to use CTAs, that they have to sell a lot of their portfolio to get some access, and then they're not getting the convexity they're looking for. Because when you can use that broad diversification, and you use that 4-quadrant model, and you use offensive and defensive assets, and you have that structural negative correlation, you can actually use, raise that leverage a little bit, or that implied leverage you can get in futures and options space, because you're properly hedged, and you create a much more robust portfolio with a much narrow band of return streams. So I think it's a little bit more prudent in those scenarios to use leverage. Now, if you're using leverage for a purely short vol strategy, that's how everybody blows up. This is a totally different use of that capital efficiency or that implicit leverage that you can get in the futures and options space.
What I find fascinating is that you take a very logical, academic, practical approach towards, portfolio construction. But you and I both know that from a brand building, AUM building perspective, everybody always wants to hear what one's thoughts are on markets.
Yeah.
How do you walk that line between, the content generation, people wanting to hear what you think about markets now, and then the reality that none of that shit matters for your portfolios?
This is one of my favorite questions. I even see all the people in the audiences. There's a lot of our Booty Crew members for Pirates of Finance. So shout out to Booty Crew, but I apologize. They probably heard me rant about this a million times. I hate prognostication. I don't think anybody can do it. But like you said, this is what sells in our business. So if I know that, right, how do I build a business knowing that's what people really, that's what gets the views, the listens, everything online. And so what we do is I'm actually trying to fire clients as fast as possible. What we do is so unique and people aren't really attuned to it. Then there's no way of me finding somebody that's using the local financial advisor and has always had a 60-40, me convincing them of long volatility and talking about first order Greeks is never going to happen. So I just cut my losses there. That's what I'm saying about firing clients. So everybody that's coming in the door, we try to make sure they've read a Taleb book, a Mark Spitznagel, Chris Cole, somebody, or have thought, maybe more of a risk parity all weather portfolio construction, right? They love Resolve, the Resolve RIP, Corey Hofstein, Matt Faber, all that stuff. We need them to be at least a little bit like-minded before we can even have that conversation. And so I just don't participate in that space. It does, like you, it drives me crazy because part of me, wants to lie and tell everybody I could see the future and I see what's coming in markets. But I've been beaten down so many times by that. I know better. And so what we try to do is we try to just be very honest about it. I don't think anybody can really generate alpha over a multi-decade time horizon. Now, do we work with some managers that think they can? Yeah. Do I like that they think they can? Of course. But what I try to do is combine them into an ensemble approach so I can get a beta-like return stream from the dispersion of their returns in their asset class and rebalance them frequently and hopefully get a little bit of rebalancing premium from them as well. But so part of it is we need to find clients that are not going to be keeping up with the Joneses, right? They just want a very boring portfolio that manages their savings over time. And this is the other thing that pisses me off that you're referencing is I'm so tired of our industry talking about your savings as investments. And this is how you should make money and retire and live off your investments. And they're going to provide you this income. They're not. That's how you take imprudent risks. If somebody is selling you something, you take imprudent risks with your savings. What you should do is, save much more than most people do. And you just need those savings to outpace inflation and be there when you need them most. But that's really boring. That's really unsexy. That doesn't get the clicks. But man, time and time again, we've seen everybody that follows these global prognosticators and they follow them right into the poorhouse.
Well, and they follow them not realizing that it's not about them being right or wrong on endpoint. See, my frustration in this business is that, for the most part, most of the macro stuff that you hear that, people regurgitate, you can't do shit with. Right? Because it's not, I always go back, it's not about the endpoints. It's about the dance in between the endpoints. It's about the path and the sequence. So like, for example, last year, a lot of people correctly said at the start of the year, stocks and bonds are due to both lose money by end of year. Everybody said stocks and bonds, or not everybody, a number of people said stocks and bonds are both due to lose money. So it should have been an easier for a lot of people. I disagree wholeheartedly because none of that tells me that 59% of the weeks the S&P 500 lost money last year, the most since 1931. 74% of the weeks last year, long duration treasuries lost money, the most ever in history. So it's more than just an endpoint. So it's frustrating to me, and I think all portfolio managers probably just like you, to see these people get large followings and be praised by people that don't understand what matters is the path, not the prediction.
No, it's my favorite. Path versus terminus is the way we always try to talk about it. And try my best to not invoke non-ergodicity of this conversation. But that's the idea. It's like, you don't know that prognosticator what their actual portfolio looks like. Everybody sees them on TV and they go, oh my God, that's a great trade. I should do that. But especially if you're following Drunkenmiller, he'll tell you all the time. He might change his portfolio right when he gets off that show. So he's not calling you up to tell you he's changed the portfolio. And then like you're saying, yeah, people might tell you stocks and bonds are going to be down this year, but like how much, over what time horizon, and what else should I do with my portfolio? Nobody's helping you in those scenarios. It's crazy to me that you could just throw out whatever conversation prognostication you want. And then later you'll come back and say, I nailed it. And nobody's thinking about the 20 other things you got wrong. But more importantly, even if you got everything right, it doesn't help your portfolio. Like, you have to know exactly what that person has in their portfolio. What are the other hedges in their portfolio? What are their other exposures in their portfolio? What percentage of their portfolio are they allocating that position? Are they using convex instruments or linear instruments? All these things matter, but people just love hearing the headline, or they read the headline that stocks and bonds will be down. Well, great. That doesn't do anything for me, but I don't know why. That's what people love to hear.
Yeah. And that's the problem. I rant against narratives, but the reality is if you're going to build a business, it goes back to the original point you mentioned, you've got to have some kind of narrative also yourself, because that's what people gravitate towards. So there's almost this cognitive dissonance. Like, I hate the way that narratives are framed. A lot of my loudness on Twitter is around attacking narratives, but at the same time, I know I also need a narrative, right? As far as getting people to kind of stay involved and engaged. And it's hard to kind of, I think, when you're naturally set of other people to try to build a business and realize that you've got to give the people what they want to some extent.
Yeah, yes and no. I hear this often, and I don't know. I think, everybody, I guess, has to have some form of epistemology, but I question that, right? Like, if I don't know anything, but I have this savings and I don't have a crystal ball, what do I do? And so my contention has always been, if I can hold all the world's asset classes and rebalance, then I should be fine. And quite frankly, that should be the global inflation portfolio. And through rebalancing effects, you should hopefully outpace inflation a little bit. I don't care what CPI or what anybody says or core PCE, what inflation is if I can hold all the world's asset classes and be globally diversified and rebalance, like, I should be just fine. And I'm trying to maintain my savings. And that doesn't require any prior knowledge base or necessarily a crystal ball. The hard part, and this is why I believe in capital efficiency too, and what we're working for with our Cockroach 2.0, is there's this whole other world of private asset classes out there, right? With private businesses and real estate and farmland and et cetera. And it's like, if you can use a capital efficient way to build those in liquid asset classes and futures and options, you can kind of use that as an overlay to buy those private asset classes as well, and then rebalance, and it creates this beautiful synergistic effect. But once again, it's like, I don't have to have an opinion. I don't really have to have a viewpoint, is if I can get access to all these world asset classes rebalance, because I just want my savings to be there when I need them most and outpace inflation. Now, I agree. It's really unsexy, very boring stuff, but I'm just trying to find the other, boring people that have given up on their crystal balls out there, and we're a safe harbor in any port in the store for them.
Yeah. I mean, I often frame things in terms of, conditions. And, when you have an approach like yours, it doesn't matter what the conditions are, because you're going to have exposure to something that will do well independent of the condition, right? I mean, which is, I'm actually very much a believer in. It's the opposite end of what I do from an active tactical, rotation standpoint, but it makes a lot of sense. Now, you've done a number of these podcasts. Just maybe talk through, I'm curious, your experience in interviewing different people, anybody that was particularly really fascinating that you interviewed that really stuck out to you? I have to tell you, I've done like 450 of these Twitter spaces. And I can tell you, for the most part, the ones that have been like favorites of mine, right? For the most part, just kind of comes to mind. But for you, what were some of the guests that were particularly interesting?
So were they your favorites because it agreed with your opinion or because it was divergent? Or why were they?
No, it's funny. For me, I like to be intellectually challenged. So like, I don't prep that much for these things, right? Like I'm listening to what you're saying. I'm trying to figure out branches. And I like to sometimes have people on that, have nothing to do with investing. Like I had a guy on that talks about body language. It has nothing to do with investing, but it's interesting to me what he was saying because I could apply it to even the way that I prospect somebody, right? I still turn it into something that's investing related. But for you, guests that you found interesting, not because of confirmation bias.
Yeah. So, part of it's going to be confirmation bias. Like I think about like when we say, Nassim Taleb book, a lot of people fooled by randomness. So the Black Swan, you're like, why do you I say, here, read Fooled by Randomness. This is a brilliant book. And what I'm saying is brilliant because like it agrees with the way I think about the world. So that's what I always worry about that, like kind of confirmation bias. But I also want to point out, like, what you just said is exceedingly difficult. And I don't think people have any idea, like, how hard it is to do all these interviews. And like you said, especially if you're not doing prep, to actually listen at the same time as you're running all the ops behind the scene. It's a lot harder to listen while you're doing these than people realize. And that's why I'm trying to get better and better at every time. But to your point, I got into this game actually, the partial reason for doing this, not only did I want to build these, portfolios in a better version than I had been doing in the past for my family and friends, but part of it was I had a thesis that hedge fund managers, investors, and traders are some of the most interesting people in the world. They have some of the highest amounts of intellectual curiosity. And yes, they may have a deep knowledge, expertise in a niche strategy or niche part of the industry. But usually if you talk to them, get them to open up, they'll also have other obsessions that, they just can't help themselves. They fall down the rabbit hole. And so you can get these really interesting conversations when you get people in our space. Now, granted, a lot of people have just been semi-disappointed because they aren't that interesting, right? They just know how to do one thing and they bring their lunch pail to work, and that's fine and dandy, but it's trying to find those interesting conversations. And when you ask, obviously everybody knows Hugh Hendry. So, the more conversations I've had with him, some have been really interesting. The very first time we went on live and he was bleeding from his head because he just smashed against the rocks in St. Bart's. So that was my first live ever, was even no green room, him just showing up bleeding out of his head. And that's how we started talking. I think about a friend of mine going to visit his house, Steve Diggle, who has, I think, one of the more interesting people in finance that not a lot of people know about. He used to run a long volatility fund in Singapore in 2008, did very well for himself, and then semi-retired. And now he owns things like avocado farms in New Zealand or ranches in Uruguay. And he pairs that with German rental real estate and a biotech firm out of London. And so those are the things I'm more interested. I like trafficking in the esoterica. Like I really like people that trade like financial transmission rights on the energy markets, or people that are taking advantage of what is it, the 1906 Dredging Act in New Orleans, and they're using those. So like, that's the beauty of portfolio construction. When you have broad swaths of all the world's assets like we do, it allows me a wide open path to like kind of pursue any curiosity and have conversations with people that have really outside of the mainstream niches that they're really obsessed or are passionate about. And those are the conversations I really find interesting. I don't know about you, but I'm always in the process of an unlearning process. It's not about what can I learn that's new. That's always, those novel things tend to jump out at me and really like it's a 5-alarm fire. And I'm like, I definitely want to learn more about those. If somebody brings up something that's actually truly novel, which is very rare. But I also find it's an unlearning project, right? I'm just trying to get rid of all the stupid shit I've learned throughout over 4 decades on this planet. And so it's about conversations. And I wish we could have them, this digital, manifestation of us being able to do Twitter spaces is phenomenal, but there's nothing like doing these in person. And that's what I miss the most, is that's where you get the best juice out of people, is just reading that body language, the energy in the room, and seeing how the shifts and changes are. That really helps for taking directly in a conversation. Like that, I don't even know how you do this. Like you're not even seeing my face or anything. Like this is incredibly difficult to run these spaces constantly the way you do.
Well, I appreciate that. I think actually what makes it even more difficult is finding guests that are not all gloom and doom, right? Yeah. No, really, because and this kind of even goes into like YouTube and just in general, when you're interviewing guests and you want to build a large audience, the YouTube channels that tend to have huge subscribers, if you look through all the thumbnails and all the guests, it's pretty much all like the end of the world type of shit. Right? And people gravitate towards that. There's no doubt about it. And it gets clicks. But, if you're going to be intellectually honest, you want to find guests that are not going to be as bombastic like that. And let's face it, those guests tend to not be draws, right? Relative to the real doom and gloom type personality.
No, you've nailed it. Like that's, I love that phrase. Pessimists sound smart, but optimists make money. is like, that's what our industry gravitates towards, that pessimism. And I think part of that is, understandably, I think highly intelligent people tend to become consequentialist philosophers and believe in this doom and gloom narrative. And they tend to look out much for the bad than they do for the good. And so, it's a really sad part of our industry. I remember when my girlfriend's a wine influencer, and one of the tenets we went with right away is like, don't shit on any wine. Like, but if she would shit on wines, she would have a much bigger audience. And we're like, the world's too big and too much fun. Let's just celebrate the ones you like and not necessarily shit on the bad. But that, like you said, that's what gets clicks and eyeballs. So it's really, it's about how you want to live your life. And the way we say, we're not perma bears, quite the opposite. Most of our family and friends that, we work with, they would be really hurt in March of 2020 or in 22. And so we're not happy or cheering when those things happen. We're not perma bears at all. We just view that we hold offensive and defensive assets. So if you want to say the offense is optimistic and the defense is pessimistic, well, if you combine them, we're pragmatic realists. And so good stuff and bad stuff happens. And we're trying to, ride the trends of the good stuff and then, hopefully protect our clients when bad shit inevitably happens. Yeah. Great question. So commercial real estate, that's what we're eventually getting into Cockroach 2.0. So as prior to the GFC, I was a commercial real estate developer. And it was honestly the pain of the GFC led me down this rabbit hole of figuring out long volatility and tail risk and how to hedge entrepreneurial risk or business risk. And so we had to build this hedging portfolio we did with our long volatility ensemble, then combining it with the total portfolio solution with Cockroach, but doing it in a very capital efficient way allows us to have that liquid asset class that we can then overlay with those illiquid privates. So that's what I'm looking forward to in the future, is building out an ensemble portfolio of these deterministic cash flows, because everybody loves mailbox money. But the hard part about it is it's non-granular, right? Like they're very difficult they put $753,625 to work in real estate tomorrow. It's just not going to happen, right? So it takes time to get those into good projects. But while you're waiting, you may need an overarching liquid portfolio like we build to hopefully help, maintain your returns or your protection while you're waiting to put that real estate to work. And similarly, you need to be able to rebalance between the two. I think there's a tremendous power to having long volatility and tail risk when we do have those liquidity events, where then you could, buy up businesses for pennies on the dollar, when you could buy up real estate for pennies on the dollar, but you need to source that liquidity from somewhere. And I think that convex cash position that long vol and tail risk can potentially provide is a much better way to source that and throwing the baby out with the bathwater and selling all these asset classes that you don't want to get rid of.
Jason, for those that want to track more of what you do, aside from Twitter, where can you point them?
So you can find us at mutinyfundsingular.com, at mutinyfund.com. Like you said, on Twitter, I'm Jason C. Buck on Twitter. My partner is Taylor Pearson Me on Twitter as well. And then you can find Pirates of Finance. Prefer you follow us on YouTube, but you can follow us on any audio player. And then we also do a Mutiny Investing podcast that I do as well on any of your podcast players. And we do a deep dive with a lot of long vol and tail risk managers and CTAs. And then subsequently it's become much more conversational after some of those deep dives. But those original episodes are all of the fan favorites in long volatility and tail risk. We do, 90-minute interviews where we deep dive into their strategies.
Place to wrap this Twitter space up. Everybody, please make sure you follow Jason here on Twitter. Again, this will be in podcast. Jim Carroll's going to be a guest at some point, I think in a few weeks in July. So stay tuned for that. Finally, Jim was always incredibly knowledgeable and very kind with his time. So we'll look forward to that. And thank everybody for joining. I will see you hopefully tomorrow. Thank you, Jason.
Thanks, Michael. Appreciate it.